Hello everybody. At this time we are talking about a balance sheet. A balance sheet lists a company's assets, liabilities, and shareholders' equity for an operating period. Balance sheets provide the basis for computing rates of return for investors and evaluating a company's capital structure. In short, the balance sheet is a financial statement that provides a snapshot of what a company owns and owes, as well as the amount invested by shareholders. Balance sheets can be used with other important financial statements to conduct fundamental analysis or calculate financial ratios. And then we move to importance of the balance sheet. The balance sheet is a very important financial statement for many reasons. It can be looked at on its own and in conjunction with other statements like the income statement and cash flow statement to get a full picture of a company's health. The important financial performance metrics include the first about liquidity. Comparing a company's current assets to its current liabilities provides a picture of liquidity. Current assets should be greater than current liabilities so the company can cover its short-term obligations. The current ratio and quick ratio are examples of liquidity financial metrics. And then, second, about efficiency. By using the income statement in connection with the balance sheet, it's possible, to assess how efficiently a company uses its assets. For example, dividing revenue by the average total assets produces the asset turnover ratio to indicate how efficiently the company turns assets into revenue. Additionally, the working capital cycle shows how well a company manages its cash in the short term. And then third, about leverage. Looking at how a company is financed indicates how much leverage it has, which in turn indicates how much financial risk the company is taking. Comparing debt to equity and debt to total capital are common ways of assessing leverage on the balance sheet. And then fourth, rates of return. The balance sheet can be used to evaluate how well a company generates returns. For example, dividing net income by shareholders' equity produces return on equity or ROE, and dividing net income by total asset produces return on assets or ROE, and dividing net income by debt plus equity results in return on invested capital. And then we move to the purpose of the balance sheet. A balance sheet provides a summary of a business at a given point in time. It's a snapshot of a company's financial position as broken down into assets, liabilities, and equity. Balance sheet serve two very different purposes depending on the audience reviewing them. When a balance sheet is reviewed internally by a business leader, key stakeholder, or employee, it's designed to give insight into whether a company is succeeding or failing. Based on this information, an internal audience can shift their policies and approach, doubling down on successes, connecting failures, and pivoting toward new opportunities. When a balance sheet is reviewed externally by someone interested in a company, it's designed to give insight into what resources are available to a business and how they were financed. Based on this information, potential investors can decide whether it would be wise to invest in a company. Similarly, it's possible to leverage the information in a balance sheet to calculate important metrics such as liquidity, profitability, and debt to equity ratio. And then we move to the main parts of a balance sheet. The first main part, current asset. Cash as well as other assets you expect to turn into cash within the next 12 months. Examples of current assets include accounts receivable, inventory, and investment that can be quickly converted into liquidity. And then second, shareholders' equity. Shareholders' equity is made up of common and preferred stock, paid in capital as well as retained earnings. Note that some preferred shares may sometimes be part of liabilities under certain conditions. And then the third, fixed assets. Property or equipment the company owns and uses in its operations to generate income. Fixed assets are properties for long-term use, and the value of property and equipment may decrease over time because of amortization, which is intended to spread out the cost of fixed assets over their period of use or wear. And then fourth, long-term liabilities. Debts and other obligations to creditors that will not be due in the next 12 months, excluding demand loans. Examples of long-term liabilities include term and mortgage loans. And fifth, current liabilities. Debts and other obligations to creditors that will be due within the next 12 months. Examples of current liabilities include accounts payable, credit card bills, sales taxes collected, payroll liabilities, and loan payments. And then we move to the types of balance sheets. The first type, comparative balance sheets. Comparative balance sheets for more than one time period are often presented in the same financial statement to indicate trends. Companies may present corporate balance sheet with horizontal analysis to determine amount and percentage changes in line items and totals, showing trends over time. And then the second, horizontal balance sheet. Horizontal balance sheets show assets on the left side and liabilities and shareholders' equity on the right side of the balance sheet. And then the third, vertical balance sheets. Vertical balance sheets show assets at the top with the balance sheet's liabilities and shareholders' equity sections presented below. A vertical balance sheet has only one column of balances for a year. Vertical balance sheet may be presented with columns for multiple years as comparative balance sheets. I think it is enough. Thanks for watching.